right, here's the agenda today. We're going to talk about cash balance plans. So if anybody's done any work in the pension business, cash balance plans are unique programs that allow large investors who are entrepreneurial with kind of a smaller operation to create cash balance plans. And you can put away significant amounts of money into a pension. We're going to talk about that with an expert, an actuary, Craig Blumenfeld. He'll be on in 1 second. We're going to talk a little bit about the new series of the Diversified Alternative Fund. Then we're going to hear about one of the really interesting tax mitigation programs that involves a land deal that also includes breeding of exotic animals like zebras and all the tax benefits that go with this. We'll have Chris Gilroy come on and talk about that. Then we're going to do a little bit of a growth story with two advisors that have done a really good job on growing, Casey Bright and Ray Sullivan. Then we're going to hear from Pete Alford at Waterloo Associates, one of our alternative asset managers. And then Chris is going to give us a full rundown on the latest on the Advisor Hub site. So this is where we're going to see everything going forward, and we're building out that site so you can have all access to all the products and services in the firm, and it's all accessible right from the 4-star SharePoint system. So Chris, I think that's it, right? Pretty much.
Yeah, that's it. So it should be about an hour. We'll see, questions, things like that, but it should be an action-packed meeting, hopefully.
Excellent. Okay, well, let's start out. We have Craig Blumenfeld. Craig, are you there?
I am. Can you hear me?
Okay, yes. And Craig, everybody, Craig is a good friend of 4-star, and he's an actuarial expert. And Craig, you're going to talk to us a little bit about, if I'm an advisor and I have an entrepreneurial client, how can we set up a unique pension plan for them called Cash Balance? So why don't you take it away, Craig? You can share your screen.
Yes, I will do
there
that.
Here, I'll stop share for you, Craig.
Okay.
There you go, Craig.
Thank you.
Excellent.
And
now,
I won't take up too much of your time. Obviously, I'll just try to whet the appetite at the moment, and then if there's any interest, you can contact Brian, and we can do either schedule a call together or something a little more grandiose. It's up to you. So here I'll go ahead and share. Can everyone see my screen?
Yeah, we can, of course.
Okay, so this is like a two-page. Flyer that I produced for an accountant, just to sort of introduce the concept to some of his clients, and just asking a couple questions to see what they're looking for. I can send this to you, Brian. You could disseminate, if people are interested in seeing this. But in a quick summary, I think this says it all. Now, notice here for 2025, here are some contributions that anyone can make in a 401k profit sharing plan. So you'll notice here at age 60, it gets kicked up because that is that super catch up. What that means is that for some reason the law under Secure 2.0 in a 401k profit sharing plan, someone can contribute up to $77,500 in 401k profit sharing money and get a tax deduction for it. But then they have this super catch up if you're age 60 to 63. No idea why that was decided. It's sort of baffling a lot of us. But in that case, it increases the catch up from $7,500 to $11,250. So this is not a typo here, and it's not a typo here. It's the actual law for the 2025 plan here. But this column here is what most people could do in a 401k profit sharing plan. A lot of times our clients come to us and they haven't really saved for retirement, and they're trying to increase their tax deductions or one or the other. And they ask us, can they do more? And the answer, has been for the last 20 years or so, yes. And that's where the cash balance plan comes in. And that's where you need an actuary to be able to provide the cash balance plan. It is not in lieu of the 401k plan. It complements the plan. So what that does is it increases the tax deductible contributions on average. So if you have a 45-year-old, you might be able to set up the plan and they can do an additional $138,000, which would be a total tax deductible contribution for retirement for assets under management, which would be equivalent to, assuming the top tax bracket, a deferral of tax of $55,200, which is nothing more than just 40% of the 138. It might be more or less than that, depending on what their effective tax rate is. But as you can see, as you get up to the higher ages, you're able to put away significantly more. So it is age-based, and there are some assumptions in here. So this might not work for every client you have, but these numbers can get pretty high, and quite frankly, I was fortunate enough to start in the actuarial industry when these numbers were getting really, really high in the past, and then they sort of cut them back. I am concerned about that because these numbers are getting to the point where they're losing a lot of revenue by having these plans. So I hope they will continue to support them. And they've been very, very fruitful for many of our clients. And, Brian and I working together on this, he's seen firsthand how his clients can benefit from it. But so what I want to show you is give you an idea of sort of, and then I'll stop talking. I'll give you an idea of like some of the clients that we tend to see to sort of give you ideas. This is a subset of a presentation I use for accounting professionals. I like to do lunch and learns because they're one of my biggest referral sources, as they like the tax deductions for their clients. But like ideal candidate one, this is an example of someone that is, let's say an owner, 53, and they're earning significant amount of money, let's say $350,000, and that's the maximum that I can reflect anyways. And so, as you can see, this is pretty much, they were in a 401k profit sharing plan. They're putting away $77,500, and then with the cash balance plan in total, they were putting away $344. So this is just any owner that has significant income, is looking to doesn't need all their income to live on, and they want the higher tax deduction. They want to accumulate wealth on a tax efficient manner. Another type of person that we tend to see is a sole proprietor. So it doesn't matter if they have employees or not. They might be a sole proprietor. They might be a single member LLC but have employees. But a lot of times we get sole proprietors that are just one company. And let's say that their earnings is $100,000. Certainly, it makes sense to have a cash balance plan when you have someone that has significant income, disposable income, and their wealth would suggest making a large tax deductible contribution. But it also helps when someone has low income if they're being minimized by their 401k plan. What I mean by that is, if you're a sole proprietor, you're known as a pass-through entity. Your earned income, in other words, you're not getting a W-2, is $100,000. The maximum you can put away is $51,000. And that's because you're limited to 25% of your compensation. But with a cash balance plan, that same sole proprietor with earned income of $100,000 can completely, if they don't need that money to live on, they can exceed what they can do in a 401k profit sharing plan, set up a one-person cash balance plan, and contribute and deduct the full $100,000, essentially zeroing out their taxable wage. So it doesn't have to be significant. You don't have to be putting away hundreds of thousands. It's anytime you're limited by a 401k plan, it may be worth looking into what a cash balance plan could do for your client. Another type of candidate is, we've seen quite a bit of these lately, is that my most recent one is, we had a CEO of a company in Wisconsin, and he it was a huge conglomerate, but we certainly couldn't do anything for that large company. But he sat on multiple boards and was pulling down close to $1 million a year in board of director comp. So we set up a one-person plan for him, and in a profit sharing plan, the maximum he could do on his own, because assuming he did a 401k with his company where he was the CEO, if you set up a one-man profit sharing plan, the maximum he could do would be $70,000. But with a cash balance plan, we're able to get him $325,000. So these are very popular for people that are on multiple boards, earning significant compensation from these boards, that do not want to pay tax, or more importantly, I say defer tax on that. And then finally, the additional candidate is very similar to the sole prop, is we see a lot of moonlighters. So we've seen, a decade ago, we saw a proliferation of privately held medical practices move to hospital owned. And yet a lot of those medical practitioners like to moonlight or like set up an endoscopy practice in addition to becoming a hospital employee. So in this example, the same thing we're talking about, they might be earning $80,000 in their side hustle. And so since they were doing a 401k plan, the 401k was done with their hospital plan. So they could only do a tax deduction of $16,000 in their profit sharing plan. But if they added a cash balance plan, they could do the full 80 again. So a cash balance plan is very useful in two ways. Really, one way is if you're being limited to your current 401k profit sharing plan, a cash balance plan may help exceed those limitations. So that's sort of what I want to sort of introduce to you, but I'm certainly open to any questions. And there is a lot more here. There is a lot more to consider. But at least this is just a brief introduction of what you might have at your fingertips.
I got a quick
That's great.
question.
Go ahead, Ray.
I have a client, the first year he's done this, he made 9 million clear at a Schedule C. No employees, no anything, okay?
Yeah.
He's gonna open up a SEP with 69,000. Is it too, since he doesn't have to file till October or fund the SEP, could he still do a cash balance by October 15th, or does it have to be established?
So that's a great question. And first I'll answer what you're asking is the deadline to fund and get the deduction for 2024, Ray, is Monday, next Monday.
Really?
No, so his filing is due on October 15th. But for a cash balance plan,
all right,
the minimum required contribution has to be funded by September 15th.
All right.
So he could theoretically fund more than that for 24. But the one thing I want to share with you is you bring up a great example. Someone making 9 million. These cash balance plans are I just sort of want to show this slide really quick, is that in a 401k profit sharing plan, they're limited as to what they can put in, but what they take out is limitless. For a cash balance plan, such as your client that made 9 million in a year, is they give you a higher flexibility of what you can put in the plan, Ray, but what you take out will be limited to and right now it's 3.58. It gets indexed with the same thing as Social Security. The same index is used for both. So that's going to grow. But the reason why I say that is you can't have a civil litigator put like $9 million in a plan, and it just won't work that way. It has to be prorated over a 10-year period. So the answer is, by gosh, if we talk to this guy tomorrow and if you could set up something to fund, it could be done, but you would have to have the plan set up so that he could write you a check on the 15th next Monday. And if he's a one-person plan, we could potentially fit that in. So maybe call me after this, and it would be hard pressed to do it. But I don't know how old he is, Ray, but that would dictate I might be able to get him, maybe in the $300,000 to $500,000 range, but it's not going to be in the millions.
No, I'm not going to push it because I'm too strapped. But this year he's going to be at least 12. So
yeah, he's got plenty of time to set it up.
Okay,
That's great.
He's about 50.
Yeah, so he might be able to put away, maybe in the 150, somewhere between 150 to 200, and it depends on where the interest rates are at the end of the day.
Okay,
Yeah.
We'll talk.
Well, thanks, Ray, and thanks, Craig. So you can see it can be a little complicated, which is why we do need an actuary to come in, and that's Craig that I've worked with, and we set up a plan for one of the deans of the business school I went to, who ended up getting a role as a witness in major litigation, and he was bringing in $2 to $3 million a year, and we managed to put away, Craig, almost $2 million, right, in that plan.
Yeah,
Over
yeah. And we
quite.
continue to do so. He's still taking advantage of it. Yes.
Exactly. So I just wanted to introduce these ideas to everybody. Do you have something else, Craig?
All good.
What happens to the cash balance plan if the participant passes away?
Similar to even what would happen with your 401k profit sharing plan, it would go to your beneficiaries.
And is there a timeline where that needs to be liquidated?
Well, a beneficiary IRA now has rules, right? Where
Yeah.
it used to be, you could put in your IRA, And then, same RMD rules apply. Now it's a 10-year payment requirement.
So it's
Yeah.
similar with the cash balance to the IRA. Is that right?
Same rules. Yeah.
I've got the same
So
conversation. He makes $4 million a year. He's sitting on 20. He's not going to use this. He's worrying about what's going to happen later.
right.
I didn't know if we could sidestep that rule with this.
Yeah, no. And
Yeah.
and medical practitioners love these plans because they are protected from creditors coming after it. So sometimes they like to have this plan, and then at least while they're building the $3.6 million up, they know that at least that amount is creditor protected. Similar to their 401k profit sharing
Yep.
plan, same thing.
Thank you.
Okay. Well, Craig, thank you very much. And
Welcome.
what we're planning to do is we're planning to have another session for those who are interested in a lot more detail, and then we'll be able to spend a lot more time. We just want to introduce it to everybody today and get everybody a chance to meet Craig and how all this works. So thanks again, Craig, for being with us.
Truly appreciate it, gentlemen. Thank you very much.
Thanks, Craig.
All right. Okay. Thank
Chris,
you
if
very
you could
much.
share his information, that'd be helpful. I'd like to reach
Yep.
out sooner. Thank you.
Yeah, we'll send it after
Absolutely.
this follow up. And like it said in the beginning, if you guys didn't see it, this is being recorded as well. I know some advisors who had meetings and weren't able to, so we'll have that recording out as well. So we should have all that out to you guys.
And I'll sign off right now and let you guys have at it. So
Thanks,
thank
Craig.
you, ladies and gentlemen.
Thank you,
Didn't
Craig.
exclude.
Thank you.
Bye, guys.
All right.
Thank you.
Okay, so let's move on to our agenda. I just wanted to reintroduce to everybody, and I wanted to talk about this a little bit more. We've talked about it quite a bit, and this year, in the last year and a half, we've had the Diversified Alternative Fund set up, and this was based on an idea of Craig Martin's, and Craig had been doing these Diversified Alternative Funds for his own client base for about 10 years before he joined Forestar. We love the idea. Now, we added 2 buckets to it, so you can see here that there's a real estate bucket, a private equity bucket, and an angel investment bucket. And I'll say this, that the angel bucket is very, very unique. And it's the only place in a regulated BD or RA environment where you can get a portfolio of angel investments. And I say that intentionally, a portfolio. Angel investments are the most aggressive you can get. So not every client is right for this, but angel investments, 50% of them will go bankrupt completely, not just down, not lose a little bit of money, you lose it all. Because you're starting really basically off plans in some cases. So angel is the most aggressive, but it's part of the opportunity fund. So that's why we only offer it in terms of a portfolio. Then in the income PPM, which is the next one down here, we have the unconstrained private credit program. And then what is new to our programs that wasn't in Craig's program is energy income, where we're investing in oil and gas programs that offer a favored income stream. Right now, on average of about 8%, but it's tax favored, so it's the equivalent of about 12% income, and that's going very well. And then we added this bucket here, which has turned out to be the largest bucket of all, the growth and income bucket. So it's got about half real estate, cash flow real estate, and then half other businesses. So the other businesses could be anything from fast food franchising to jet leasing to communication services to cannabis, and a whole series of other things. And so that's become the largest of all the buckets. We raised about $10 million in Series 1. So now what we're offering is Series number 2. It just opened about a month ago, and we've had our first 2 clients get into it. So I would encourage everybody to have a look at this. When you consider that a stock and bond portfolio can earn you, if you have like a blended 50-50 portfolio or 60-40, you could get maybe 10% or a little bit more out of your stocks if you're more successful at it. That's what the markets have done over time. And then the bond market will pay about 3%. So the blended return is somewhere around 7%. So if you can get a 7% return and that fuels your financial plan, how do you get that 7% to go to 8, 9, 10, and 11? And if you know numbers about compounding, you add 2 or 3%, it's massive over a period of time. So the alternatives really are the key to getting better returns. The other really interesting aspect about the alternatives, whether they be done through the fund or direct, alternatives also don't get marked to market every day like the stock market. So they lower the volatility of the portfolio overall. So you lower the risk of the portfolio and you get better returns. And that's what Harry Markowitz and some of the Chicago professors I work with would call that nirvana. So you take a higher risk asset, you add it into a portfolio, and you get better returns because you have a slightly higher risk asset depending on the mix that you use. And then you also lower the risk of the overall portfolio. So this is the Diversified Alternative Funds now. This is going to be series number 2, and we have an internal series. And let me just show you the fact sheets for these. No, I won't show you the fact sheet, but we'll have all that stuff available, and we'll be sending out a marketing piece to everybody. But just so you know, the Diversified Alternative Fund Series number 2 is open and open for business, and we're accepting qualified clients into the Opportunity Fund. A qualified client is an investor who has $2.2 million of net worth overall in liquid net worth, or $1.1 million with your advisor. So if you have someone that has $1.1 million of liquid net worth with you, then they're considered to be qualified. And that's for the 3 more aggressive buckets in the Diversified Alternative Opportunity Fund: the real estate, private equity, and angel investments. And the Diversified Alternative Income Fund, there's 3 buckets, but you only need to be accredited. So if you think about an accredited investor who has $1 million, right? They say the SEC says accredited investors are $1 million or better. How would that person ever get diversified? But let's say if you took $100,000 and you split it between a couple of these buckets, maybe you use some of the real estate, maybe you use some of the energy income, some of the growth and income. Each one of those buckets is going to have 20 different investments in it. The only one that didn't have 20 was the energy income in Series 1, ended up at 19, not 20. But nonetheless, very, very well diversified. So 100,000, you've got 60 programs that you're invested in. There would be no way you could functionally do that with the minimums in an alternative investing. So that's why the fund is really good for investors with less than $3 million overall liquid net worth. And of course, anyone that has just accredited is $1 million. This is a perfect vehicle for those folks. So we're going account by account and client by client to see who doesn't have this program, and that might be a good idea for each investor to take a look at that. The fees are not exorbitant. Usually when you deal with alternatives, the fees are 2 and 3%. Our fees are about 2% overall when you consider it. And then also for advisors inside the firm, you get 1% of the management fee. So you'll get 1% if you put somebody into the Opportunity Fund. It's an ongoing management fee. And then in the Income Fund, it's 0.75. Okay, so you're going to get, a similar type of fee that you would normally get if you put that money in stocks or bonds. So we didn't want anyone to feel like if you put money in the alternative fund that you wouldn't get fees or you wouldn't get as good of fees. You're getting about the same amount that you would get if you put the money in stocks and bonds, but you're getting a lifetime of investing in these programs. I'll also just share with you that this has become popular enough that we decided to offer these shares outside of the firm. So let me show you what we call now the Phoenix shares. And I was just at the FactRight conference talking to other sponsors about being part of this. We're taking sponsor money in to be part of the program. And then we're going to offer outside the firm just 3 of those 6 buckets. So we're going to offer the income shares that we just talked about. In the income shares, we're going to be offered the private credit and the growth and income, and then only the private equity and the opportunity. So we're not offering real estate, we're not offering angel, we're not offering energy income to folks outside the firm. So you as 4-star advisors have the opportunity to invest in all 6 of the buckets, and we're offering this limited group outside the firm. The firm now has about $1.5 billion in assets, but there's significantly more assets outside of 4-star than there is inside of 4-star. So we think that the Phoenix class of series number 2 is going to become very, very large. We've got about 30 firms that are already ready to sign up for it, and then we're going to be doing meetings with their investors also to show them the benefits of doing something like this. And so I just wanted you guys to see it. And here's just a one-sheeter, so you can see it's different, that it's only got 3 buckets on it. It's series number 2. They call it the Phoenix class. And then there's a fact sheet that I'll put up on the screen about the Phoenix shares as well, just so you can see it. And again, you guys have the opportunity to invest in the main program, and the main program has all 6 buckets, okay? So the Phoenix shares are live. The regular Diversified Alternative Fund in Series 2 is also alive. And so we're eligible to get involved in it.
Guy.
Does anybody have any questions on that? I heard somebody.
I think Ray was.
Sorry, that was me. I just found out that that Charlie Kirk who got shot died.
Yeah,
Oh,
he
no.
died?
Oh, no.
Oh, my goodness.
Yeah,
Oh, God.
That's
Oh,
horrible.
boy.
Trump just
Yeah, I heard about
announced it, I
that.
guess.
God.
Oh, boy.
Sorry, I thought my audio was off. I'm sorry.
Okay.
I've been waiting
no
to
problem,
figure
Craig.
that out too, actually. I saw that notification earlier.
Yeah, that's a very sad bit of news, Ray. Charlie Clerk was great for the conservative movement, for sure, if you're a conservative. So, yeah, really quite sad. So, okay. Anybody have any questions on the Diversified Alternative Fund? Okay. We've talked about this before, and I'd like to reach out and have a conversation with each of you to talk about the fund and how we can use it to give your clients better returns, and then see what would be the appropriate way to be involved. Okay. Is Chris Gilroy with us today?
I am.
Chris, welcome to Four Star. We have our monthly meeting here, and Chris is one of the leaders of Wildlife Partners, and we like to hear from Chris to learn about how to invest in land and exotic animals. Chris, are you there?
I'm here. Can everybody hear me
Take
all
it
right?
away.
Yep.
Take it away.
Awesome. I want to share my screen real quick.
I'll stop my share, and you can take it over.
See if that worked.
It's coming on right now.
We can see your screen now.
Okay, awesome. So first, thanks for everybody that showed up today. We've got a little bit of a unique story over, I think, other things you probably have seen over the world, around the years. We met several of you guys at the MIC Law Conference back in, I think it was April, and we were looking at increasing our selling group this year because we've got a large fund that is much larger than anything we've ever sold in the past. So we were looking to increase the group, and thankfully, Four Star thought it was great, and you guys have welcomed us to your platform. So we have two offerings. In the essence of time, what I'm going to do is just give you a little bit of company background and then talk specifically about the highlights of each program and the differences between them. So this was literally a hobby that became a business for my brother and I. So back in 2011, 2012, we were buying some animals just for fun, and it was a tax dodge at the time. If you purchased animals for the purpose of breeding, the IRS views those as business equipment. So you could deduct at the time 50% of whatever we spent on an animal, we could deduct against other income from other sources that year. So we started doing it. It was cool. We had animals like these bongo that are, on this page here. We had sable, we had kudu. There was these amazing animals from all over the world, mostly from Africa. And as part of the fun and the excitement, we discovered there was actually a very substantial industry to the tune of, there was an economic impact study done in 2007. And at that time, it was $1.3 billion just in the state of Texas. That study was updated in 2016. It was over $3 billion a year just in Texas. And we believe that number is about doubled since 2016. So we were doing it for fun, sex appeal. These animals are beautiful. They're great to have on properties. And the money took over. We discovered something could be very lucrative. So we decided to put a fund together and go out, structure one, and sell it. We just sold it to people that we knew, kind of friends and family, if you will, people that were already investing in our other business. Well, we sold that first $5 million fund in 30 days. We've since sold 26 funds, totaling over $140 million invested in us. This industry is not new. It's been around since the 1930s, and we are without question the leader in this multi-billion-dollar industry. What I mentioned earlier was if you purchase animals for the purpose of breeding, they're considered business equipment. Well, I'm sure most of you are aware that the One Big Beautiful bill passed back on July 4th. But what that did is it took bonus depreciation back to 100%, and it made it permanent. So there's several factors that are substantial for what we do around bonus depreciation being 100%. First is, if somebody's investing in our standard animal program that only includes the animals and not the land, they're getting a 91.5% deduction this year, showing on a K1 as a business loss from farming. That's got a lot of different benefits to it beyond just a regular deduction for those that know the farming rules. Even the land deal it's got a 55% deduction because bonus appreciation for livestock is now back at 100%. But there's another factor of it that's important. We are now in the business of producing. We've always been in the business of producing animals. Well, we produce animals that are sold to our customer base. We produce an asset that when it's purchased by our buyers is 100% tax deductible in the year that they buy it. I don't know of another industry where the end product that you're selling to your customers is always 100% tax deductible to them that year, but that's the position that we're in. It's a very unique thing for our industry. It's a very unique thing for our funds. That bonus going back to 100 is substantial because it was done using a reconciliation bill and it was made permanent, which means the only way that that ever gets reduced from 100 is if a new legislation, a new leader comes in and they want it removed from 100, and they would have to have a 60% Senate majority for that to happen. So a little background about who we are, what we do. We started off with 270 acres, one ranch. We had a handful of animals and a little bit of staff. We now have 5 properties, including our office, which sits on some acreage just northwest of San Antonio. We have 4 fully staffed ranches covering more than 11,000 acres in size. We're managing over 5,000 animals across more than 50 species, including many that are critically endangered. The animal that's on this slide is a Kenyan mountain bongo. Those are critically endangered. What we do is a very true impact investment. In fact, it's the only real impact investment I've personally ever seen that actually checks all of the boxes. There's a big deduction on the front end, called charitable, if you will. This is more just a straight tax deduction from depreciation. We've proven that the investment vehicle works. We've had 3 funds liquidate. They've all made money. They've all had multiples on their investment capital above and beyond the tax savings they got on the front end. And it's wildlife conservation. The animal on this slide is from a specific area of Kenya. It's the only species of bongo that was ever imported to America. And there's only about 50 left on the wild. On our ranches and our funds, we've got about 100 of these. So we have twice the amount of them in our ranches than there are left in the wild in Africa. So you can see very clearly what it does for wildlife conservation being an impact investment. And just for perspective, the mature females on these, which is the one that's got the horns, we sell those for $140,000 each and have a waiting list. The young female, which is below her, that's her calf. When they're about a year old, they sell for about $100,000 each. So you can see if you've got an animal that produces an offspring that happens to be a female that's worth 100 grand, how they can provide an actual return on investment. The last thing I'll leave you with here is our staff is amazing. We've got about 100 FTEs across salaried people and contractors. They are the best of the best in the industry. We have very little turnover. We have a very dedicated, loyal staff, and they know what they're doing, to include our veterinarian that we got from Africa back in 2018. So before I move forward to the differences between the 2 funds, are there any questions? Okay, let me skip forward here. I'll give you the details of the funds. Okay, so we have 2 programs. I'm going to start with the program on the right because it's our standard breeding program. This is what we've been doing for the past 10 years. So this is an $11 million fund. The minimum investment is 100 grand. There are 2 ways to approach our standard breeding programs. One is a regular direct investment using non-qualified money where you're going to receive that 91% deduction. The only thing that's not deductible are the selling and dealer commissions. So actually with you guys being RIAs, your clients are going to receive at least a 8% deduction, but they're going to get that as a K1 showing a business loss from farming. So we've got to acquire the animals, they've got to breed, and then we don't sell the animals until they're at least a year and a day old. There's a reason for that. Despite being in the business of producing these animals for sale, they're considered 1231 long-term properties, which means the income generated from the offspring sales is taxed at long-term capital gains. So you get a really nice ordinary deduction on the front end, but you're paying capital gains taxes on all of the income that's generated, which is, again, that's a pretty rare scenario. The cash flow on the deals will not start until about the end of 2 years because of that time frame that I just mentioned. Our expected cash on cash return that we're looking for is about a 1.5 multiple in addition to the tax savings. Our first fund liquidated 2 years ago. They saw a 1.6 multiple. Our second fund, which is our worst fund by a mile, they lost 20% of their herd in the first 2 years. In fact, it was in the first like 14 months. So they really started rough during our growing pains, our growing curve, if you will. They still are going to manage a 1.2 to 1.3 multiple plus those upfront tax savings. And then our third fund also got out of the gates rough, but made a massive rebound. They'll be liquidated next month for about a 1.75 multiple plus the tax savings. Now, there's something substantial that's part of this fund that we've never had before. I've been working on it for about 7 years. We now have insurance on the animals. So that thing that happened with our second fund where they just got kicked in the gut right out of the gates, that's not possible anymore because we're going to have insurance on every animal over $25,000 in value or higher, up to 50% of the total value of the herd. So what that does is it completely eliminates any chance of a significant loss in those first 2 years because of the insurance policy. Any questions on that fund?
Yeah, just real quick in general. On that deduction, wouldn't those be passive losses through the K1?
So we have the ability for many different paths for people to get 100 hours with us. We've used 100 hours for the last 10 years on all of our funds, and that's worked for us. So the way you get hours with us is you come make this horrible trip to Texas and you go do an African safari on the ranch. So every hour on the ranch counts. So when you're there for 3 days, that's 75 hours. The rest of the time, people attend our auctions. So we have a fall auction the first weekend in October. It's again a full weekend deal. It's a Friday, Saturday, Sunday deal. We have a lot of partners there for that. And then we've got hours and hours and hours and hours of content that we put online that is all designed for people to be involved with understanding how you manage parasites in wildlife, how you make sure you're stocking your animals the right way, how you're handling the land the right way, tax components. Like we have a tax, I don't know what I call it, tax class, if you will, for ranching that's coming up at the end of October. And we'll probably have 50 to 80 people attend that. It's a paid event that we do for our customers and their CPAs. So there are ways to get the 100 hours that you need to get. Most of the people that we work with are taking it as an active deduction. They just have to do some things. We do provide some tools to help track what they do with us. So they can, if they are audited 2 or 3 years from now, they can show what they did. We will also vote on all of the animals to be purchased between now and the end of the year. So there is a method where, generally speaking, in other investments, there's nothing you can do. There's nothing to be active with. So did that answer your question, Ray?
On your question, yeah, that was great. Thank you. Yeah, no, that was excellent. Who are your customers? Who buys the animals? Are they private parties? Are they zoos? Or
So we do some business with zoos, but it's limited and it's mostly us buying animals from them. Our customers are wealthy landowners in Texas. It's not the hunting community that most people come out of the gates thinking because we're in Texas, we love our outdoors, we love our guns. That's not what this industry is about. They're less than 10% of the ranches in Texas that have animals. 90% are our customers. They are wealthy people that are either captains of industry or they're business owners. What's consistent about all of them, they're all wealthy. We currently have 7 billionaire clients that buy animals from us. They're scattered through Texas. We have one in Florida, actually 2 in Florida. We're stocking a ranch right now on the border of North Carolina and South Carolina. He's a billionaire. The biggest thing to understand about our buyers is, which there, by the way, there's about 6,000 ranches in Texas that have exotics on them, is they get those same tax benefits I mentioned earlier. So they buy animals for the purpose of breeding. That's very key. It's got to be for breeding. They're now deducting 100%, but now they're deducting feed, labor, vehicles over 6,000 pounds, anything affiliated with that breeding business. Well, because we'll come back at the end of the second year and we'll buy any offspring they produce they're willing to sell us, they generate revenue, which justifies it as a business to the IRS. They avoid the hobby designation. It turns their ranch into that dirty word called a tax shelter. It's a business.
Chris, I think this has been really great. I think we have to leave it there. So this is a very unique program, obviously, and there's a lot more to discuss. So, Chris, you'll be able to take calls from folks that want to learn more about it. and possibly
Absolutely.
do
That
some
was kind of
tax
the point of it. We
mitigation?
can share this deck with everybody, but yes, if you guys want to schedule individual calls, there is a lot more information about industry history that's almost 100 years old and more.
That's
Yeah,
awesome. Thanks
I'll
for
follow
being
up.
with us.
Good, Barry.
No problem. Go ahead, Chris.
No, I was just gonna say I'll follow up, Chris. I'll get this deck, and then, like I said, when we release the recording, I'll include the deck as an attachment below so people can download it.
Awesome. Sorry if I took too long.
No, I'm sorry
No,
I
no, you're
occupied all
fine.
the
Thank you.
questions.
No, thanks, Ray. No, it's really a very unique program, and it's part of our tax mitigation structure within the alternatives area. None of these programs will appear, however, in the diversified alternative funds because they're individual tax programs, and so they're not eligible to be in the funds. So this would be something you do outside, along with the other areas we've talked about: oil programs and fee simple real estate programs, charitable corporations, historic property trusts. So there's a whole series of things that we have on our platform, and this is one that we've recently added in the last 6 months. So we have some investors who've done it, and I think we're going to have more. So thanks, Chris Gilroy, for being with us.
Thanks, guys. Appreciate it.
Thank you.
Okay, so today what I wanted to do is, I know we've seen some advisors doing really, really well, and I wanted to highlight 2 of our advisors that are doing really great things on the growth side. Everybody wants to have more business. Question is, how do you do it, and how successful are you at it? And I wanted to highlight 2 of our advisors that have actually been very successful at it. Some of you have met Casey Bright. He joined the firm in earlier this year, in January officially, and he just recently landed a $7 million account. Casey, you want to tell us how you landed that account and how you're growing so fast in your business? Are you there, Casey?
And I won't hold you all up for too long. I honestly, I think that the answer to this is process more than anything, but we have standard operating procedures for just about everything we do in our office, and I think that's where it begins. And I'm trying to give credit to Jennifer in our office because she does a lot of that. But we unfortunately had a client pass away last fall, and we had worked with her for quite a while. And we left contact information. We always give people a nice binder of like, hey, here's who to call if something happens, and they put it all in one spot. And that way they know to call me and we can guide them through the process. We also have an estate checklist. So one of the first things we do with people when they sign on is we kind of make them do an estate plan. It's kind of part of what we do. And then at the end of that, we put a checklist, put it in that binder with them, and then send it on the way. Well, her sister found it, and she came in, we guided her through, and I think what really happened is she saw what happens when you actually have somebody local that's in person that can help with this. And she said, I did a trust 10 years ago, and I have an advisor in Pennsylvania, and I can't remember his name. It would be really nice to make sure that my 2 sons have this same process in place. And she said, we like you all, so here, take all this. She was a vice president for Toyota. The other one, just a gentleman that I've been working with, he's had like a $50,000 account with me for years. And he's a pilot, had 3 million somewhere else. And same thing, walking him through the estate plan, walking him through life insurance, walking him through retirement and the actual planning on money guide. And he said, you know what, you do a lot more for me. Let's just send it on. So again, it's just process and working more in depth with people.
But that's the beauty of it, though, is that if you have a process and you build a process into your business, things like this are going to happen to you. You're going to find opportunities, financial planning, executive planning. It all works. And thank you, Casey.
Absolutely.
And I'm
Thank
sure
you.
you'd be willing to share more with others later on if they have questions, right?
No doubt about it. Yep.
Awesome. Thank you. Congratulations on your success, Casey.
Thank you.
And then this other guy who talks a lot, he's on the call, Ray Sullivan. This is your chance to talk some more. Ray, you've been one of the most successful advisors, bringing in lots of different accounts, wealthy folks, and then some, $1 million, $2 million here and there. Tell us how you've done that, Ray.
I wish I knew. No, I have a very unique practice, probably different than most, is I have a large accounting practice, a big tax practice. So I think what it stems from is, first of all, it is process, even not as formal as Casey's, which is just fantastic. It's listening, always returning phone calls, and trust. So a lot of advisors out there will tell their investors or their clients that, well, consult your tax advisor. Well, then they consult me. And this might be a new advisor that they're working with at a bank or whatever. And I end up talking to them. And they're like, well, you do this? Yeah, the big sign on, yeah, but forget that. Yeah. And they're like, oh, I'd rather give it to you. So a lot of it's referrals, a lot of it's trust, and a lot of it is my practice. Like I've always said, I've got the worst business model. I would get an F at any graduate school of business because I get 80% of my time. 80% of my time, I make 20% of my money. It's wrong, but that's how I get the other 80% of my income is with that other time with taxes and accounting. So I have, and that's the way I started. So it was very hard to transition over to being straight financial planning and investing. But I think a lot of it is listening, seeing what the people have and offering suggestions with no, preconceived notion of what the client needs. And most of my clients are like, yeah, right, whatever whatever you want to do, but they trust me. And I think that is the key thing. And even though I'm so busy on the other side, when an investment client calls, they get called back within, during tax season, it might take me 2 hours, but I call them back immediately. So that's, I would say, the retention of my clients. They know I always return their calls. They all have my cell phone. So I think that's a comfort level.
That's great.
How do I bring them in? I ask questions. When they come in with the money, also, what do you want to do with it? Well, what could you put me in? No. Wrong way. What do you want the money to do for you? What is this money? So it's kind of like process, like Casey said. You have to, whether it's you got to ask. They will tell you. The products fall into place. But if you don't know what this is supposed to do, and I think that's another reason for my success is I always know what the money's supposed to do. And I put it in the products that I know and trust.
Nice. Well, great. Well, thanks, Ray. And Ray, you'd be willing to talk to others as well about your process. Then you say you don't have a process, but you clearly do, and how you bring folks in. But both you, Ray, and Casey are well over 100 million and growing quite rapidly. So congratulations.
Thank you.
All right. And thanks, Casey. Thanks, Ray. And then, these are two of our finest in the 4-Star Network. We have a lot of others as well, so we're going to hear from others over the next couple of months as well as we see folks have success. So thanks again, both of you, for being with us. We appreciate it very much. Okay, we have one more presentation by Waterloo Associates. We have Pete Alford with us today. Pete, are you with us today?
I am. Thanks so much. But I'd really like to turn it over to our managing partner, Brian, and sincerely appreciate the time here with you all. So we're new to the platform. We've got a unique strategy in the real estate space. I'll turn it over to Mike, who can really run through this creation of his, which provides high current income. And think of it like an asset-backed bond. I'll leave it there and turn it over to Mike.
Okay, Mike, we got about 7 minutes to present, and we'll take a few questions.
Perfect. No problem. That's great. Thank you. Thanks for having me. So I will get right to it. Let me share my screen. Is that working?
There it is.
It is.
Perfect. Okay. Quick background on the firm. Firm named Waterloo Associates. We're based in Austin, Texas. We have a satellite office in Dallas, and we're an interesting firm. We're a unique blend of an operator, what you call an operator, and a GP, if you will, like on the private equity side. So we operate directly for large institutional clients as their sole GP and operator. And we also raise our own closed-end funds that are direct to us. But everything we do, we negotiate, structure, develop, service, whatever the strategy is, we execute it directly ourselves here in this office. This strategy in particular is a structured finance play. It's a structured finance strategy. And what it's designed to do is to be extremely downside risk protected and provide an outsized current income stream, right? A current cash flow income stream. It has to do with off-balance sheet financing for very large home builders in the United States. So again, I'm going to get right into it. So this has to do with home building in home builders in the U.S. If we're talking top 25, top 50, I think there's over 400,000 home builders, in the U.S. We're talking about big daddies, the biggest companies. None of these guys went down during 08. All these guys have hundreds of millions, if not billions of dollars of net assets on their balance sheets. They're financially stable. They're manufacturing companies, really, is what they are at the end of the day. They're churning out homes. They're doing thousands of units a year, and they constantly need inventory, in order to do this process, right? To build these homes. Well, the most critical component of a home builder's inventory is their land. The land and the development of the land, meaning the horizontal development, the road, water, sewer, drainage, all this stuff you have to do horizontally to prepare the land to go vertical, right? For them to build their home. A home builder really wants to build their home. That's how they make money. They build the home quickly. They sell it for a big margin. They build the home quickly. They sell it for a big margin. They can do that fast. What they can't do fast is develop land, right? That takes a long time. It takes a long time to move the dirt, get stuff entitled. It clogs their balance sheets, meaning they have to hold, if they hold a bunch of land on their book, then their assets are higher. It doesn't turn like a home sale does, yet it's critical inventory. So what we've done, and this is our deck, I can send this out if it's interesting. What we've done is we have gone to the home builder and said, hey, home builder, we've created a strategy that essentially allows us to purchase land that is already on a home builder's book, or that is going to be purchased by a home builder in the normal course of their business, meaning they have land identified for their future business, right? Their future homes to be built and sold. And instead of them buying the land and holding it on their book and funding the development, which is what they will do many times, we will buy the land. We will fund the development of the land, and they will buy the lots from us at a pre-specified price, takedown schedule, everything. We basically eliminate all the risk associated with the development of the land that you normally face as a speculative developer, meaning if you're just a guy out there buying land, developing it, and hoping a home builder comes and buys it for a market price, there's a lot of risk in that, right? That's a risky strategy. You can make a lot of money, but that's a risky strategy. What we do is we go to the home builder and say, hey, look, we're going to buy the land for you. You're going to indemnify us for everything that can go wrong, possibly go wrong on the site. You're going to give us a completion guarantee for all of the work. We engage the home builder as our contractor. You're going to pay us a current rate on the money we have out into the site. So as we are literally funding the development of this site, the home builder is submitting draw requests to us, just like you would a lender. We're funding the draw request. We audit it, AIA documents, all the normal process. Every month, as we're funding capital out the door to complete this site that's for this home builder, they're paying us a current rate of return. And that current rate is somewhere between 12 and 15%. It's A over 360. It's an annual rate paid on a monthly basis. So they pay that to us starting at the month of close and all the way through the deal, right? Mm-hmm. As they buy lots, as these lots are completed, they must stay on schedule that we set out at the beginning of the deal. So, if we say for one deal in month 10, the home builder must start buying 10 lots a quarter. So month 10 hits, you got to start buying 10 lots a quarter at a specified price. There's just one price. They have to buy those lots whether they're ready or not, right? There's no option to not buy the lots. They have to purchase them and continue purchasing them on or ahead of schedule throughout the entire deal, right? Eliminating the delay, cost risk, cost overrun risk, market risk, things like this. This strategy is designed to essentially provide these very large home builders, these very large manufacturers of homes, a leverage facility for their land and horizontal inventory, right? That's what it's for. It's not meant to take development risk. We don't take that risk, timing risk, cost risk, entitlement risk, none of it. The home builder's parent company is the one that takes on that risk in this strategy for us. So what really happens at the end of the day in each one of these projects, and I'm skipping over the details, so please feel free to ask questions. We structure it to where when we come in and purchase land, we're buying it at the original basis that the home builder has it under contract for or purchased it for directly. Sometimes that basis is 3 years old. Most of the time that basis is pre-entitlement work. So we're at an extreme discount day one when we buy this land. The other thing that we do is we charge these home builders a very large upfront fee when we execute this deal. It's anywhere in the realm of 10 to 20% of the entire project cost. They pay us up front, right? So for example, if land is 10 and the future development of the site is 40, the entire project cost is 50. We charge, in this case, typically on a development deal, 20% of the 50 day one. So the land was 10, we charge 20% of the 50, they pay us 10, we own the land for 0, right, in the structured process. We then fund the development of the site. We charge them a current rate the whole time. They must purchase the finished lots on time, on schedule, all contracted. 100% of the lots are spoken for at the beginning of the deal with a huge upfront deposit given to us by the builder. And once all the lots have been purchased in the deal, that returns our principal to us. They've paid us current the entire time, again, like a lender, except we own the site to keep it off their balance sheet for them. Wall Street likes that. And the deal's over.
It's a great strategy, Mike. It's a great strategy. Let's see if there's any questions.
Yeah, any questions? No reversion. There's no market risk. It doesn't matter what cap rates are doing. It's an asset-backed bond, as Pete said, each deal.
I've got just
Any
two quick questions, or actually 2 points. Since you're coming in as the middleman from somebody that's family owns a lot of property and are involved in selling lots and properties to the big builders, it seems to me that on both sides of the coin, that's going to be dilution for the property owner and also future dilution for the home builder. So if I'm a landowner looking to sell 2,000 acres to D.R. Horton, why would I go through you all when I could just go straight to them?
Great question. You wouldn't be going through us. The home builder comes to us. So you would be dealing with the home builder directly. The home builder, in your case, D.R. Horton, would put the land under contract with you. The home builder then comes to us while the land's under contract and says, hey, Waterloo, can we do your strategy on this? You assign the contract to us at close. We pay the purchase price. You don't care who the money's coming from, right? Just like a lender, we pay the purchase price so the builder doesn't have to. We hold the land on our book, fund the development over time. The builder pays us a current rate. They get the lots just in time when they're ready. They don't carry the land and the development of the land on their book the whole time, which is major, which is big,
That's
for
great.
these guys.
Thank you, Mike. We just got a peer took a little look at what you guys are doing. We've seen one other purveyor that is doing something similar. It's a great strategy, and we were proud to have you guys on our platform, and you'll be in the next Diversified Alternative Fund Series #2. So thank you, and you'll be available for questions, and can you get us these slides, as you said?
Yes, yeah, of course. Yeah, happy to chat on any aspect or deal or, part of the deal.
That's great. Thank you, Mike, and thank you, Pete, for being with us. We appreciate it.
Thank you.
This
Thanks,
program
guys.
is listed on our platform, and I think it'd be a great program for investors. It certainly, as I said, will be in Series 2 of the Diversified Alternative Fund. So thanks, Mike, and thanks, Pete. We've come to the end of our meeting. Chris Reardon, do you want to give us a quick update on the Advisor Hub? We're going to run a couple minutes over, folks.
Yeah, I just wanted to highlight real quick, and I'm going to keep it very brief, but just highlight real quick how to access it. We've kind of showcased this before, but never kind of the soup to nuts of it. If you go to
Is it sharing? Uh-oh, we lost Chris.
Can you guys hear me now?
Okay, he's back. Okay, very good. Go ahead, Chris.
My Zoom has just been crashing. I don't know why. So hopefully it doesn't happen again. But let's see if this. Okay. So on our site here, you see the FSW Advisor Hub. If this is your first time logging in, you'll get a sign like this. Hit the Forgot Password button. Put your 4-star email in there, and it will send you the password. So pretty quick and easy. You'll be able to set your password or however you want from there. Let me jump back real quick and just show you kind of what it looks like, just to kind of walk you through it. So if I have my own login. I've already logged in before. You just put in your email and the password that you set, and hit login, and then this will take you to the site here. What's coming down the pipeline, we're really pushing on kind of learning center as far as capabilities. I know we've highlighted before in here as far as like tax mitigation strategies. For those of you that haven't seen it before, we do have like the webinar on that here as well. Strategy summaries. Wildlife Partners is has a strategy summary in here. Filtered objectives, things like that. So just a lot of information that's useful. A couple things that are coming down. We already have them 90% inputted. It's just getting some of the video data just takes a while to upload. But I'll just kind of even give you a preview. We're going to actually get the last conference, all those uploaded on here. So you'll have that to go back as reference and things to pull from, which I think will be a great resource. All the showcases, this advisor monthly meetings, all of that is going to be included on here in a nice simplified format for you as well. So one of the things we're pivoting to, and I know I want to be cognizant of time, but just a real quick showcase is we're pulling a lot of our stuff to YouTube as far as videos. And I just got done recently cutting the showcase last week, but just to give you an idea, so like on here, we have all the presentations from the conference that are already up and on. So it gives you kind of an idea as far as what's available on here. So really good presentation, really good information. You can see a lot of, obviously, all the different even panels, things like that. So we're going to take a lot of this information. We're going to drive a lot of it into YouTube to give us a lot of that flexibility, a lot of that polish to it. And then we're going to pull that into the site. So a lot coming down. There's a lot more, but I know we're kind of over time here. So, we'll continue to push and discuss a lot of it on the Monday meetings as well. So
excellent. And you said the tax mitigation materials on that site as well?
Tax mitigation's on there. The showcase, I just cut it. It's actually just got it on YouTube, so that should be up. I was hoping to do it, but once again, doing these videos, pulling gigabytes of data, it just sometimes it just takes time to upload, download, things like that. So that should be up tomorrow probably. I do have everything kind of done to it, so I just need to pull that through. And then everything's up on the conference, so that's going to be going up hopefully later this week as well. Like I said, the hard part's getting the videos and everything up. So
all right. Well, good. Thanks, Chris, and you'll give us another update later.
Yep.
Just so you know, the coming soon, we're going to be announcing in the next 2 weeks the conference for December. Rather than give you any detail right now, we'll wait till the major announcement. So be ready for that, and it should be our biggest conference ever. We're also planning to do special sessions on philanthropic planning, on executive advising, showcasing the 4-star regular portfolios, the 4-star investment management as well, the stuff that we work on every Monday morning at our investment meeting. And just by way of reminder, everybody here is welcome to join that investment meeting if you'd like to. We don't have an open invitation, but if you ask to be invited, we'll let you in so you can see what we're doing. And so you're an access person, so we have certain rules and controls over what you know about the investment portfolios, but nonetheless, we want everybody to have access to it, and we'll share all that with you if you join on to the investment meeting. But so we're going to be doing conference, philanthropic planning, executive advising, and then another special review of all the portfolios that are available, at least in the firm's 4-star investment management, should you choose to use that. All right, Chris, is there anything else we should cover?
Nope, I think that's it. I know we're a bit over, so I want to be cognizant of everyone's time. I think we're good. Thank you, everyone.
Okay, everybody. If you have any questions, we covered a lot today. Cash balance plans, the diversified funds, wildlife partners. We heard from some great advisors, and we heard just from Waterloo, and now the Advisor Hub. So if you have any questions on any of this, need help, call any of us in the development team, and we're happy to help you. We're a few minutes over time, so we're going to call it right here.